How to accumulate and distribute positions during the expected great bear market of 2026. Here's my plan for AMD, which is currently just 0.3% of portfolio. I think it was about 5% at its maximum, so I've sold over 90% of what I accumulated during the bear market down to 80 into its bull market of 269, 270 nearly. So I'm primed and ready to increase exposure once more, to rinse and repeat what I and my patrons have already done several times. I remember at AMD at sub 124, we're calling it the advanced money destroyers. So while it might look easy, I accumulate here, distribute here, accumulate here, distribute here. It's not easy. It's not as easy as it looks. You have to accumulate and distribute for the duration of the trend, i.e. distribute, accumulate, distribute, accumulate, distribute, accumulate, going to something like 150% invested by 80. This is when folk were puking. So look, saying here accumulate and distribute sounds easy, but at the time it's not. The advanced money destroyer, folk here at 100 were asking me, Nadeem, do you think it will go to 120 so I can get the hell out of AMD? My reply was, I'm waiting for 180 plus. That's my base case. The AMD will trade to 180 plus, and you can see why. Look, you got resistance there, so it should at least get to 180. Then it's got this hurdle to overcome. No, it hit that and then it retraced and then it blasted through it. I said at 100, base case 180 plus, but I would not be surprised if it gets to 250 plus. And it achieved both targets. This was the base case. This was if we get lucky. And we've got lucky. Very lucky. But luck is not what people perceive it to be. Every position you put on that makes a profit is getting lucky. Every. People don't get that. You know, you have to place the bets. You have to be positioned to get lucky. And you can increase your luck by buying when cheap. i.e. as AMD fell, you accumulated more. Anyway, let's get back to the topic. So how to accumulate and distribute during the bear market going forward. Forget what we did in the past. Yeah, we made a lot of money buying it below 120. But that's in the past. Now let's look what we're going to do during 2026. Let's keep it simple. 10 shares equals 100% exposure. Yeah? So how would I accumulate and distribute that during 2026? Well, first of all, let's get the lay of the land. As you can see here, 66% drop, 66% drop. That's pretty, pretty repetitive. So let's put that in so we get a lay of the land. What could a 66% drop look like? It would take us down to 80 again, obviously. So let's go up a little bit higher. So call it 90. So in a replay of previous bear markets, it could trade down to 90. Against this, my buying range for what's on the spreadsheet is 158. This does change slightly, but not much. I try not to change. I should have done it in text. So I'm making a mess. 1, 2. Alright, so that's the buying range. A bit of a mess. So 158 to 112 is the buying range. So let's work out the lay of the land for that. From 200, it's 35%. Sorry, it's 35% from 200 to get to the high, and from here to the top of the buying range of 158 is about 38. So we're about halfway. So a 38% drop takes us into the top of the buying range. And what else shall we measure? Let's measure from the current price to the maximum low, and we'll roughly so that's a 55% drop, and from the current price to the bottom of the buying range. See, this is how you get the lay of the land, so you know where you are. So 112, let's get down to 112. Let's do this first. Okay, so now one knows the lay of the land. Yeah, 43% drop to the bottom, 20% drop to the top of the buying range, and it's down from its high already. 25% drop, and to get back to the high, it's a 35% gain. So now we know the lay of the land, where the risk versus rewards are. And from what I can tell from now is that given a 25% drop, your first buy would be here at, well, just less. What have I done? Your first buy would be around 196, so basically where we are. So that's the first buy. Let's color code it green. Now 25% down, this will be half a share, so we committed half a share here, and at the same time it peaked at 266, or 256 will be your first sell, half a share. Let's put that in orange, you can see. So that's your first buy, half a share, first sell. So accumulate now around 196, which is basically not far off, and put an order to sell what you just bought here in case it pumps. And that is the first accumulation and distribution point. The next would be at resistance, at support just above the buying range, which is next support. So I'll put half a share here, 180. See, I'm not buying, even though it could drop to 90. I'm not waiting for 90 to accumulate. I would buy at 180, half a share again. See, now we got, see, and we can work out how this plays out in the future. So you can go back and see how it played out, how much profit we made. It's all about making profit. It's not about buying the bottom or selling the top. It's the spread between where you buy and where you sell. That's what you want. And what I'm trying to do is to allow for either outcome. If it drops, I buy. If it goes up, I sell, and I make a profit. So if I buy here and it goes up, I sell, and I made about $50-60 profit per share. That's quite a sizable profit. Well, half a share. So these are half shares because they're higher risk, because obviously I'm expecting it to go lower. And then we come next to the buying range around 160, where you'll buy your first full share. So I've now bought, by 160 I bought 2 shares, yeah, or 161 call it. So I bought 2 shares by now, half one, you get it? And I put order it now. I would put another order in to sell that half share at 226 here. So by the time I own 2 shares of the 10, I've got order to sell 1 share in 2 halves. Yeah, so you get it. So the price has fallen to here, I mean to 160, and I own 2 shares, and I've got a half share sell there and half share sell there. So if the price suddenly shoots up and goes there, I've sold half and then comes back down, I start buying again. But now I made a profit of, well, we could do it from either, from here to there. Now say the price keeps dropping, well, where will I buy my next share? It'll be, now we're into the buying zone, so there's going to be a cluster. This is where the main buying is. So call it 150, the next share. That's 3 shares. Let me do the buys first before I do the sells. But basically, when I put on a buy order, I also add an order on to sell. So now I bought there, I'll put an order in to sell another one at maybe 220. So put order in to sell there. I should go across, isn't it? So you can do time. So order to sell. So the next buy is here at support 130. I would do it. It's a cluster. I did 152. Now I'll do it around 142. So go across. Let's do a few buys before I do any more sells. So the next one will be at 136. These are all at support levels, keeping the lay of the land in mind. See, at 136, do you see what the lay of the land is? Yeah, I call it lay of the land. Look, from here to the maximum that you expect, $90 is a 30% drop. But from here to the previous high, previous all-time high is 100%, 97%. So really double your money. So the risk of further drawdown of another 30% worth making 100%. So buying this and selling it near its high, you've doubled your money. Okay, let's keep doing it. Let's not put selling. All right. So the next buy is, in fact, I would do at 122. We're getting towards the bottom of the buying range, so I would do 2 here. Let's do a thick bar. So that's a double. So 2. So what have I bought? I bought 1, 2, 3, 4, 6. Yeah. So next one. Now look, what do we do? Yeah, we're coming towards the bottom of the range, and here 112 we bought another double. So how many we bought now? We bought 1, 2, 3, 4, 5. Let me count. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we're 90% invested, and we're at the bottom of the range. What do? We continue buying as it drops. So here, say if it drops to 98. You're getting close to the depth of how far it could go. Got it 100 and buy one at 101. 101, that's 10 now. So now 101 we're fully invested. And we keep going lower and lower, and at 92 we buy another one. So we're now 110% invested. This is at the maximum now. See if it keeps falling. Keep buying. This is how I got to about 140% invested, because it kept dropping. At 80, another one. Let's say 75, another one. Let's say it doesn't get to 75. Let's say it gets to 80. So now what am I? I am in fact, that would be a double. I would buy a double, go big. So we have bought 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Let me count again. 1, 2, 3. There's one hiding there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12. 120% invested, which is pretty similar to what I did during this bear market. But on this one, I also distributed. Yeah, accumulated, distributed, accumulate. So that releases profits. Now as it's dropping, I'm also adding sell. So by here I will put a sell in at 182. Single sell. So that sold 1 share. So that's half 1. So by 112, the bottom of the range, I would put my next sell. See, where you put your sells, it depends on your exposure. Yeah, if you're less than 100%, then you want to put your sells further away. Like I'll put it at say 162, the next sell. Now say you've got to 120%. Is it 120%? I think. Right, let's count it again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So 15, 150% invested by 80. So imagine it's here. Where would your sell? You're 150% invested. Imagine where your sell would be. It would be here, 136. High probability of being achieved, and you're making a profit. So you sell one here, and your profit would be on that share bought at the very bottom. Your profit would be 70%. Do you get it? I'm not waiting to sell at 260 because I'm overexposed. I've got 150%, but I'm making 70% on what I bought at the bottom. You don't know where the bottom is in advance. That's why you're accumulating. And this one at 90, I would sell that share. So I've sold half. So half of this. So here I would sell at say 152. Yeah, so 152, and that would be, so I bought it here and I sold it there as 50%. That's the target. That's what I'm aiming for, to make around 50% on what I buy. So by the end of all this, and say the market has risen back to 200, it's done this bear market and it's gone back to 200, what's my state? What's my state of play? I have bought 150%, and against that I have sold 1, 2, 3, 4 shares. So I'm by this time here I am 110% invested, and I made profit already. I already cashed out profit, but I'm making 50% on the shares I bought down here. Most people fix it on the average. Oh, they say I'm down. Oh, you know, my average is 120. Yeah, but you bought 80. Why don't you sell that at 120? Yeah, that's 50% profit. If you buy at 80, a share at 80, and you sell it at 120, you made 50%. What are you bitching about? What are you moaning about? People fix, they don't. Average, yeah, you got an average. It's a guide, but it's wrong. It's where you buy, you take that from the way you will sell, and this is how you manage a position, like accumulating as it drops and distribute as it goes up, making profits of 50% of what you paid. So by here, those 4 shares, 1, 2, 3, 4, have released a huge amount of money back into your portfolio, plus the 50% extra profit that you made. So it's like 60%. So 40%, you got 20% free to accumulate again. So now if it drops again, so it's back at 200, so now it drops back to 136 here, you would buy again 1 share. So now you got 120% invested, but you've already cashed out the profit, and you keep buying again, so you accumulate again. But now you made 20% on what you sold. If it keeps dropping, see, you're capitalizing on whatever the market does. If it goes if it goes up, my throat. If it goes up, you distribute, you sell. If it goes down, you buy. Simple. It doesn't matter. Well, it matters depending on what your exposure is. Obviously, down here, you're 150% invested, so you want it to go up. Obviously, because it's gonna be drawdown pain if it keeps falling to 60. And you keep buying, you're going to be 160% invested. You're going to be in a deep draw. This is what the patrons experience, sub 120. They're in deep drawdown pain, because that's a 40% drop from 120 to 80. Where is it? 120 to 80 is a 30%, 33% drop. That is painful. You bought the low, your average is 120, and it's still falling. What I did was I kept buying because I know I'm going to sell what I'm buying not at 260. I'm going to sell what I'm buying at 80 at 130, 128, 126, 50% profit. That's what I did. That's what I was doing. And then if it fell again, I would just reaccumulate. So whatever it does, I'm accumulating or distributing. As it's dropping, I'm accumulating. As it's going up, I'm distributing. All with the eye on exposure. The aim is to get around 100% exposure. But you don't know because you don't know the trend. It could be like this, which was good. The 24 to 25 trend was great for accumulating, distributing. It was great because of these wild swings. Look, this is pretty wild from here to here. That's 30%. That's good profit. You can make good profit on 30%, and I did. And then we got it again. So not just once, 40%. So what I accumulated there, I distributed. What I accumulated there, I distributed some of, not all. And then by here you're thinking, oh, he might do it again. So accumulate, but he didn't. He kept falling and falling. This is how I got to 140% invested. It'll probably be similar. I'll get to about 140% invested if it gets down to 80. But that's fine. What I buy at 80, I won't wait for 200. I'll sell at 136, which is what I did. And then 150. The problem is the many investors, they sell too much too early. They don't. But now you realize what I mean by accumulating and distributing. See all these lines? I'm keeping an eye on the lay of the land to see what the potential is and how much profit potential. Buying at 80 and selling at 130 is a huge profit. Yeah, 130. You're making 70%. Think about that. And whilst I am thinking about this, folk are thinking about the average. Oh, my average is 120. Oh, I'm not making any profit, little profit. Oh, it's not worth it. I'm just going to sell everything and get out. Where I'm thinking, okay, yeah, I've accumulated big exposure, 150%. Now I've got a 70% profit on what I bought here. And what about what I bought 90? I've got a 45% profit. This is how I do it. And then, okay, so I bought this here at 102. I'll sell that over 160. And now I'm not liquidating the whole position. I'm trying to get down to 100% invested because I'm extended here. And say if it didn't fall, say if it fell to, say my buying range 112 and I'm 100% or 110% invested, then my sales will be higher up. They will be at 180 and above. So I will reduce exposure. So by the time it gets to the high, I'm down to whatever AMD does, whether it bottoms at 112 or 80. By the high, I'll be about maybe 60% invested, no matter what it does here, because I've accumulated and distributed my way out. And by the high, I would likely have cashed out more than I put in. So the position by 260 will be zero cash, hard cash. So everything I've spent buying, accumulating, by here will be free. So the position will be zero cash at risk, or by accumulating and distributing. Now we can look as things transpire during 2026, how this that I'm posting on the 23rd of February maps out into profit as per share. So you got the buys there and you got the sells there based on what gets triggered. Yeah, you can see them. So these are the sells. 1, 2, 3, 4 4 1, 2, 3, 4, 5, 6 sells based on what gets triggered during the buys. So if it falls to 112, then obviously these these two won't get triggered. That might, yeah. If it goes to 112, then these sales won't happen because there's not enough profit from 112. Okay, I'm gonna have to call it a day there. I was gonna mention Nvidia earnings, maybe in another video when I've got my voice back, or I might do an article. I think I'm getting the flu, the sore throat, so my voice changed during the video. Alright, I think it's time for a cat video. What do you think? Yeah, that's a little cat video. And this video is a mere fraction of my extensive analysis that is first made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $9 per month, which is nothing compared to what you get access to. I try to do best by my patrons. Folk only need to go read my articles open to the public and the literal thousands of comments under them. Look at this one, 2,200, nearly 2,300 comments under this article, which shows the level of engagement with patrons. Keep calm and carry on buying AI tech stocks as they deviate from their highs. Where the greater the deviation, then the greater the buying opportunity presented. Keep calm and carry on buying. Quantum AI tech stocks. Access to my latest mega analysis, a comprehensive 3-part guide on how to really get rich during 2020. That has exclusively been made available to patrons right now. You can go and read the 3 guides right now, full access, which is a truly epic piece of work that took me the whole of 2023 to write, which condenses down my lifetime knowledge and experience down to some 60 chapters, which is on top of my ongoing analysis and trend forecasts that are made available to patrons for just $5 per month. There are no bolt-on extras, no courses, no other crap that all these con merchants do. You get full access to everything. So, did you buy the October 22 bloodbath, especially in tech stocks, FANGs, with the likes of Meta plunging below $100? Well, I and my patrons did. Go read my articles and the comments posted under them. We got well blooded by catching all those falling knives. Did you make the mistake of listening to the likes of Clown Kramer on the Cartoon Network, who stated Meta, amongst others, was finished? Meta finished at $100 a share. It was the mother of all buying opportunities. This clown stated it was finished. Says it all about Clown Kramer and the Cartoon Network.
They're finished. They're finished as places.
They're finished as
places to invest.
We keep talking about this falling knife as if the knife continues to fall. Though there are people who look at this and say,
look, I'm looking at the money coming out. Where's the money coming from to buy to buy industrials? It certainly isn't coming from new people saying, "Wow, it's time to put money in the stock market," because they get such a great rate on the 2-year. I think it's money coming, rotating out of companies that have dominated this market for the last decade and into companies like Caterpillar who actually know what the hell they're doing.
Are you thinking that the tech companies that I think that you're disappointed in are going to get religion, if you will, and get disciplined? And what does discipline look like?
You know what they are? I would call them atheists. They believe in nothing.
That's a nihilist.
Meta? I don't know. I think they have to change the name again. They really do. I mean, you can't be saying Meta. I don't know. How about loser? How about stupuda? I don't know. Anything doesn't even matter. I don't know if they can make a comeback. The facts have changed, and I have to change with it. I believed. I thought I'd be safe. I was wrong. Bottom line, forget being leaders. Big stocks are now followers in a post-COVID era, where we're learning that their earnings were far more inflated by the pandemic than we knew. We're just now discovering that tech emperors have no clothes, if they're even emperors at all.
So at least give it a try, read the comments, see the depth of analysis. You won't be sorry because I do my best by my patrons. Go that extra mile. Gaining access to over 35 years experience. Right from before the 1987 crash straight through to this stock's bear market. That will ride the quantum AI megatrend into the future.